You're wondering how it traded into negative.
Yes.
Yeah, me too, to be honest.
I already knew. Okay.
Who wants to get this? You want to take this first, Chet, and I can.
Yeah, sure. Okay. So the way it works is that you have a place called Cushing, Oklahoma, where prices are settled, right? So in the last slide that Danny mentioned there, all contracts are specified in the Chicago Mercantile Exchange for quality specifications and whatnot. One of the specifications for crude oil is to be settled at Cushing, Oklahoma, where they settle the price for WTI. Now, there are many ports all around the world where oil price gets settled. Like, for example, Canadian oil gets settled over in Alberta. There's different grades over there. But the one that trades in the futures market, that one is settled in Cushing, Oklahoma. If you guys remember the commodities class where I showed you guys exactly where Cushing, Oklahoma is, that is the Cushing, Oklahoma that we're referring to.
Okay.
Now, that is a place where storage for oil also takes place, right? That's why you have Cushing oil inventory there, right? In the storage inventory also takes place in that area. What's happening right now is that there's an overabundant supply within the crude oil market. And because contracts are becoming delivered, so the deliverables of the crude oil market is taking place right now, and they're being settled there, and there's literally no more storage left there. Traders are left essentially trying to find a place to store it. So in that sense, you can't find storage even if you wanted storage to pay for it, right? And because of that, traders who are trading these leverage contracts, who are taking delivery of it, right, have no place to hold their oil. So they are literally giving away oil because they don't have a place to store it. Okay?
Yeah, understood.
Okay.
Yeah. So
it is a little bit of a complex concept, and it also ties down to the fact that we covered the concept of contango within the markets. What we're seeing is a super contango within the markets, right?
Right. So when you buy a futures contract, remember, we didn't say this explicitly yet. We'll cover it in detail later. But you can either do one of two things, right? You can actually receive that product that you went long on, right? Or you can cash settle. And since we're speculators, most of the time we cash settle, not most of the time, we always cash settle. Okay. But don't forget that the nature of futures is to actually buy that thing, right? In terms, for hedging and the other side of it, right? The hedgers. Okay. So when, a lot of times if people don't understand how that works, and they, buy a futures contract, they don't realize that expiry is, it was today, right? Yeah. So they're going to have to take that thing. Now, who wants to buy oil contracts at this price? Nobody, right? So now these contracts are going to have to be delivered, and where do they go, right? So this is why, the price went negative, because they're essentially paying somebody to store it for them because it has no place to go.
Okay, perfect. So now the excitement about this price, was there money to be made? How do we make money out of it?
Well, don't forget, to short something, you have to eventually buy it back, right? So if you shorted and oil went to zero and beyond, how are you going to get out of that trade, right? So
right.
So what's happening here, Hassan, is that the May contract, which literally expires tomorrow, right? That's why you're seeing the crude oil contracts trading like negative $40, right? But once that oil contract gets settled, the market will move on to the next month contract, which is the June contract. The June contract is actually trading roughly around $21 at the moment, right? Yeah. And that right there is what we call the super contango. Is that this contract now is a negative 40, but the contract next month is $20.
Yes.
Right.
So, yeah. So just to be clear, that does not mean the price of oil is minus whatever, right? That means that for this particular contract to exercise that, you would have to, the negative in price is taking into effect the supply shortage, the storage shortages.
Yeah. Very interesting. Okay. So